Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for December 11th of 2023. Start off the chart pack this week with a little discussion on equities and the investment markets. You can see here on the left-hand side, we got the S&P 500 large cap indexed. You can see the tale of two markets really over the last handful of months. You can see here as we entered the latter part of the summer and into the fall, the market was profoundly weak, and then literally in the span of about 30 to 45 days, we've seen a tremendous resurgence. And in fact, looking over here at the bull-bear spread, we've gone to a point of like almost a capitulation level of bearishness, and that's completely reversed. And a lot of that has to do with the feeling that we're going to avoid recession, that we're at the end of our rate tightening cycle, etc. And as you can see here, in a relatively short period of time, we've gone to really a new level in terms of our technical health of the market. And so you can see here that we're now about 2/3 of the market is of the market constituents rather are above their 200-day moving averages. And I've shown you moving averages in the past as kind of an indicator of market health, and also market breadth too. So the fact that we've got the majority of index constituents now trading above their 200-day moving average is a pretty healthy sign heading into the end of the year. This slide, we have some information from Richard Bernstein. We just got through talking about how the market breadth has improved, the market health overall has improved. We'll talk about some potential headwinds looking into 2024, but by and large, everything feels good right now. But this is kind of looking back over the balance of 2023. I've highlighted for you here this statistic that really jumped out at me, and we haven't seen this since the tech bubble in 1998 when we had the Asian financial crisis. There were some other things going on, but you can see here that the percent of stocks that outperform the index thus far this year is exceptionally low, and just a sign that the market had very, very narrow leadership, which is, it happens from time to time, but it usually is mean reverting. And it's good to see now that we're seeing a little bit more breadth in the market than certainly what we've seen over the first 10 to 11 months of the year. Now, you can't talk about 2023 without talking about the Magnificent Seven, or the Mag 7, or whatever moniker you want to put on it now. But, it is an interesting discussion, and it really is a case study of, not getting too focused on, small increments and microcosms of time. Because if you look at over a broader context, make no argument that the Mag 7 has done extremely well this year. We can certainly see that. But if you go back into last year, I mean, there are some of these that were down 50%, and here's the 50% level. And so when you think about what happened last year to the balance of these stocks, they've really kind of recovered what they lost from last year, and it looks really good. And there are some exceptions to that, NVIDIA being one that has done extremely well for a number of years. But in a lot of cases, the stocks that are getting a lot of attention right now this year for their performance were ones that were particularly weak last year. Now we'll continue on here with our discussion of the Magnificent Seven here. Again, data from Richard Bernstein Advisors. They do some really good work. And so they did a screen across the entire S&P 500, looking for companies that have greater than 25% next year expected earnings growth. And so there were only 3 of the Magnificent Seven companies that even placed. And when you think about the largest growers, they weren't in that bucket. I mean, you had to go down the line a little bit before you found the first one, and then you had to go even farther down the line to find 2 other of the Magnificent Seven. And so what that tells you is that that growth in that Magnificent Seven, in many respects, it's not been fundamentally driven. It's been because they're you could almost call them meme stocks, that everybody wants to own them. They've got a name of their own now, and everybody wants to own that basket because they're trying to chase the train that's already pulled out of the station. And so, this is Richard Bernstein reminding us that, just because these Magnificent Seven stocks have reacted this year, that a lot of that actually has to do with recovering losses from last year and kind of mean reverting, so to speak. And over here, they on that same screen, and by the way, there were 83 companies that screened out of greater than 25%. So that's 83 out of 500, basically. And then the sector distribution was the other thing I was going to point out here. And you could see that, the distribution of those, we actually see a lot of discretionary energy, companies on this side. Then you've got, the ones that are taking away. You've got industrials, and you've got technology, oddly enough, right here in the middle. So, the Mag 7 stocks are predominantly technology, and as it turns out, fundamentally, they're not necessarily the best stocks, although they are currently the highest flyers. Now we're going to talk about valuation on a relative and absolute basis here with the S&P 500 and the Russell 2000. So, we got the S&P in blue and the Russell 2 in gold. S&P 500, has a fairly broad representation of the economy. It kind of represents about 80–85% of the economy. So it's a pretty broad index. Russell 2000 tends to represent a lot of smaller companies, and honestly, they have a lot of companies that just simply aren't profitable. And so, you can see here, this is estimates as of July 1st, and these are estimates as of around Thanksgiving. And so you can see the transition, 2023, looking pretty sanguine, and that hasn't changed, although small caps as defined by the Russell 2000, the outlook for earnings has gotten a little bit less optimistic. And I think basically for the most part, the outlook for 2024 hasn't changed. So a lot more growth expected in the Russell 2000. You come down here, we look at valuation. You've got the trailing price to earnings ratio here in the blue. You got the forward in the gold here for the S&P 500. Again, not cheap, not really expensive either, but just not really cheap. And the Russell 2000, you've got higher multiples in some cases because companies are very unprofitable or not posting no profits at all, or relatively unprofitable, I should say. And so these valuations are higher. But the S&P 600 represents small caps specifically. So this has a kind of a broader connotation, but this is the valuation differential we're going to be looking at heading into next year. So you see about 13.5 times, more or less, both trailing and forward PE. Not a lot of growth expected in the S&P 600, the small cap area. And, but you can see the valuations are a lot more attractive here than in the S&P 500. So a chart here from Liz Ann Saunders and Charles Schwab. You can see that this line over on this side represents the fact that we've had almost 300 consecutive days of an inverted yield curve. And so, that tends to correlate to recessions. It certainly hasn't yet, but it is worth pointing out in a data series that goes all the way back to 1969. Here we have some data from B of A Global Research, and I thought this was very interesting because we're heading into a year that there's broad expectations of rate cuts, and we'll talk about that in a second. But given the fact that there are such high expectations, I thought it was really interesting to take a peek at what the rest of the world is doing. And as you can see here, in this chart here, we already have a lot of global central banks that are cutting, that they're easing, and you can see that here, going back to August of 2022. You've seen some rate cuts. At the same time, you've seen the U.S. go up, and that's why our dollar has strengthened, although that is looking to reverse a little bit here near term. So just interesting to note that as much overlay and overlap as we've seen in certain economic indicators, that clearly not all central banks are moving at the same drumbeat right now. A quick look here at private debt. It continues to grow as non-bank, or excuse me, as the non-banking banking sector is continuing to grow. We see conventional banks become a little bit tighter on credit, and we've got a chart on that, but you can see here what we'll call the non-bank sector is continuing to grow at a fairly strong clip. We like to keep our finger on the pulse of this because this is something that the Fed is obviously interested in. They want to know, what kind of money is being lent and being deployed out into the economy outside of the traditional banking sector. And you can see a lot of that money is going into private credit here. So we've got 424 billion. About 56% of it is going into private credit, and you've got private equity here, and you still have some real estate debt. And so, we talk about commercial real estate a lot. And have over the last several months. But it's still an area where you're seeing a lot of private money being allocated to. And in a lot of cases, it's trying to take advantage of price dislocations. But here, clearly, this is helping the economy continue to expand. Now, granted, these terms are not nearly as favorable as you'd get from a commercial bank, but, it is access to credit. And you can see the fundraising, numbers right here. Now we're going to dig into some economic data. We did get this data here on Friday. Non-farm payrolls were 199,000, a little bit lower, although higher than expectations. You can see the 2023 average. And so, we've seen a handful of months now where, that overall payroll number is trending down. You can see clearly the line of best fit here is looking like that. So we are seeing a moderation in the labor market, although in many respects it still remains fairly strong. We've got wages over here. We've got hourly earnings, weekly earnings against the consumer price index. And you can see a line of best fit there, kind of like in a slow trend down. Now, these have been sticky. We're kind of hovering now around 4%. Again, it's the direction that the Fed wants to see. In fact, you could argue that this is kind of a Goldilocks kind of scenario right now. This is exactly what they're looking for: slowing in labor, moderation in wages, and indications of continued trends in that direction. We have the labor participation rate for the prime working age, and that is defined here as 25 to 54. You can see, those that are in the labor force, those have, and I'll just say for lack of a better term, kind of declared themselves available for hire. You can see that number is higher than where it was. We've recovered greatly. Now, those in the labor force are not necessarily indicative of those who are actually employed, and that number here is in the green. And so you can see that number has basically, reclaimed its pre-pandemic peak. Although interesting of note here is that we've seen a little bit of a tick down here. Again, indication of slowing overall economy, not necessarily a cratering, but overall good trends to see here. Here we have some data from Charlie Bolello. This ties back into the equity markets, and so it's just kind of like a marrying up of economic and investment data. And so it tells you, and when I talk about this, it'll seem fairly intuitive, but when you're at a high point of consumer sentiment rankings, you tend to have lower overall returns in the equity markets over the next 12 months, and that's because you are in many respects probably closer to a peak in consumer sentiment. Well, it does change over time, and obviously if you assume that you're at the at a trough of consumer sentiment, and we've been lower on consumer sentiment. I'm going to show you that chart here just a second from now, but you tend to have much better earnings. And so when you look at the next chart, just keep this in mind. So when we're coming off a low stretch in consumer sentiment, you tend to have much better equity performance. So here's a chart of that consumer sentiment index. You can see here, how it does oscillate over time. And If you look over the last several years, and it all started with the pandemic and it just got worse. And then so, lately we're coming off this bottom, but we're well below levels that we've seen in the past. And so, this type of a dip, again, is very consistent with recession, although, you do have some false positives in here, but, clearly these areas represent periods where we did have a recession. Obviously left to be seen whether this manifests into a recession, but we are clearly coming off the trough in consumer sentiment. And so, that goes back to that last slide that, you tend to have better overall equity performance under that scenario. Here we have the Fed funds rate versus core PCE inflation, personal consumption expenditure inflation. And you have seen this chart before from Charlie Bolello that I've reposted here. And this just goes to show you that we have Fed funds rates that are actually meaningfully higher than core inflation as defined by the measure that the Fed uses. And so, you could look at this and say that we are exceptionally tight right now in terms of credit. And this would argue for having these rates come down next year to more closely match what we're actually seeing in the core PCE. And along those lines here, we have the market implied probability of a rate cut. And this is through March. Now, I just read through the National Association of Business Economists outlook. And so this is like a compilation of a lot of different economists. And most are expecting, in fact, 80% are expecting a rate cut in 2024, but for it to start in third quarter. And so this is a pretty high probability, as we're looking here, around 60% of the market implied probability by March. So the big question is, does it happen by March, or is it more closely aligned with what the National Association of Business Economists, or NABE, is expecting? Now you can see this trajectory here. This is just the market expectation for the pace of interest rate declines. And so this one may not line up completely with where the consensus is right now, but the trajectory is clearly on a downslope. And what's really interesting, though, is that you have a dichotomy of opinion. There are some economists out there that kind of defy what the NAB is saying and are expecting rates to be higher for longer. And you don't want to fight the Fed, and you certainly don't want to be incredibly wrong on your expectation. But this curve, could have something more of a flattening up here, and then it begins to trail off down here. And it may not trail off nearly as much. We just don't know what that's going to look like. So this is looking out into 2025, and a lot can happen between now and then. But this is at least what the market is implying. Quick look at GDP. This is actually a data series going back to post-World War II. You can see that we used to have lots of variations in economic growth, with kind of an average that fit along this line, which actually does fit as we continue that line all the way through. So if you look at overall growth of around 4.5% as kind of like your average. But we are seeing a much narrowing of the range of outcomes here. And so as we sit here, today, looking at something on average of around, maybe 3%. Now that's for 2023. Now 2024, might be a little bit more subdued. Current expectations are for a fairly modest fourth quarter growth rate, fairly modest, if not, maybe flat number in the first quarter, and then looking better towards the end of the year. Quick look in here at the Atlanta Fed's GDP now, and you've heard me say this several times, but the Atlanta Fed, this particular calculation has done an exceptional job of forecasting GDP, much better than you see the consensus. And this is blue chip just alludes to the fact that, it's just a bunch of economists that are projecting this number, and this average, has kind of from the end of September has kind of like gone up a little bit, and you can see where the Atlanta Fed, and they pretty much nailed the third quarter GDP number, and they're actually bringing their estimates down to kind of coalesce around maybe 1.25% right now for overall annualized growth for the fourth quarter. We have money supply. We've talked to you about this on many of occasions. You can see money supply is almost always positive, but we had such a huge stimulus, I mean, an unprecedented stimulus and growth in money supply that we're seeing a snapback. And so generally when you see lower money supply growth and certainly negative, you would expect inflation to drop. I do subscribe to the opinion though that this is just merely a snapback from the pandemic period. And you can see that this is a percent change over a year, and this is a 2-year change, so it smooths things out a little bit more, but you can still see that snapback very much in play here. This is a chart from Game of Trades, and we talked about the probability of a recession. That number is kind of oscillating around 60% in this data series. Now it looks like this is data produced through August, looking out 1 year ahead from the Bank of New York, and I can say from August through November, that number is maybe a little less than this, but you can see relative to history, this isn't a level that we've seen for quite some time. You've got to go back to the early 80s before you see this indicator trip here. And even if you assume that it's gone down to like 50 or 45, it still is relatively elevated. And again, going back to the NABE's recent release, 3/4 of their economists have a 50% or less recession expectation over the next 12 months. Personal savings rates, we've talked about this too, very low. So you talk about the health of the consumer and the outlook for the economy. You have savings rates that are pretty low. We've been spending out of those savings. We certainly have been spending down excess savings to achieve consumption goals. Here we have the cumulative excess savings that I was just alluding to in that last slide. You can see from August of 2021 that we've been continually drawing those down. This is a chart from Charles Schwab, and down here they actually run the numbers where they take personal disposable income minus personal consumption expenditures, and you can see how those are now consistently in the negative. So it's just reinforcing the downdraft of this data series up here. So looking at credit, this is kind of a proxy for overall credit. This is just credit card or revolving credit. So you can see outstanding credit on a multi-year basis. Again, pandemic kind of stunted that, and then we had kind of a trough in 2021. But we've seen a consistent growth of credit through really almost 2 years now, and at a lag, because it does look like we're slowing a little bit. We're seeing that delinquency rate begin to pick up just a little bit. Here we have job openings, talking earlier about the labor market really being in a sweet spot as far as the Fed's perspective is concerned, because you've got job openings that are going down. We did have unemployment go down, but you've also got these job openings, and then you've got, particularly in retail trade, we've seen a particular drop here. Now, professional and business services, we've seen the drop, but we've actually seen a little bit of a more recent pickup, but just a general overall slowing in the labor economy, not necessarily a bad thing at all. Talk about lending for a second. We have two charts, and honestly, I think to some degree they kind of conflict with each other, but as we saw earlier, the private credit sector is kind of kicked in, and you have access to credit if you're willing to pay a lot more for it in terms of an interest rate or other provisions in your loan. But you can see here the traditional banking sector after Silicon Valley Bank has been moving lower in terms, or I guess maybe moving higher in terms of its conservatism in wanting to lend. And we see that very clearly in all of the senior loan officer surveys. This data comes to us by Federal Reserve Board, so it's painting that picture of credit being kind of choking up, and that is very consistent with the chart that I showed you a few slides ago on negative money supply growth, because you're not lending that money, it's not multiplying within the economy. Here we have a Goldman Sachs U.S. Financial Conditions Index, and this is a very noisy chart, admittedly. I think the key is over here. The last data point was very solidly in the red, which actually indicates an easing of U.S. financial conditions. And you can see that we've had some pretty strong tightening here within those financial conditions, but clearly over the last month or two, we've seen very much of an easing trend. Talk about rent. This is national rent. I'm trying to hit on the things that tend to influence inflation. We have the labor market and wages. We talked about that. We've got rents that are also sticky. We can see here, this is data. Both of these are data from Apartment List. And so you have the percent change year over year through November. And you can see that that's negative 1%. And it's been negative for a few months now. We've been watching that. That's a good sign. Rents are coming down. You can see in the aggregate, those monthly rents are moderating still and moving a little bit lower. Here we have vacancy rates. We know that we've got more product coming on the market. We have more new builds, units, multifamily that are coming online. Although we do see kind of a trailing off, if you will, in spending on the multifamily construction sector, but nevertheless, we do see that vacancy rate continuing to kind of like eke up a little bit, and that should help to keep rates low and perhaps maybe even moving continuously to the negative for the coming couple of months. Talking for a little bit on mortgage rates here, we have in the light blue line, we've got the effective rate on existing mortgages, and we know that the vast majority of people have a mortgage rate that's below 4%. That has been coming up, obviously, with the increase in interest rates. But, for the most part, this has contributed to a lack of mobility, a lack of inventory on the market. You see new builds coming online, and builders are buying down those rates by 2 and 3 percentage points, but you can see new mortgages coming out here, at the time of this data, and I don't have a time stamp on this necessarily, but it was closer to 7.7 as we've seen interest rates move down over the last month or two, that number is much closer to about 7% right now. So they have come down, but you can still see that differential and see how that's been impacting the issues with regard to the housing market. On to manufacturing for a couple slides here. We've got the Institute for Supply Management, ISM, Manufacturing PMI, which is a Purchasing Managers Index. And so, we are still negative. We've talked a little bit about, within this whole broader context of whether we're going into a recession or not. As a total economy, you can argue that we've been in a manufacturing recession for a number of months now. And so this goes to what Liz Ann Saunders at Schwab calls kind of like these rolling recessions within the economy. And I definitely subscribe to that. I think, we get caught up in the conversation of, are we having negative overall economic growth? Well, the answer to that is no. We did for a very brief time at the beginning of last year, but it wasn't substantive. But I will say that I think the manufacturing sector has been in a recession for a little while now, and you can see the number of months of manufacturing contraction, and how that pales, or how that compares rather, going back all the way to 1950. Here we have some components of the ISM manufacturing, and as you can see in this chart, that all of those have been negative for the last couple of readings here. We've got, again, we got new orders, we have production, we have employment, we have inventories, and we have supplier deliveries, all negatively contributing to that ISM PMI number. Here we have an interesting overlay, S&P 500 net revenue surprises. So this would be the, would be maybe an aggregate or a percentage number. Actually, it is a percentage number of companies within the S&P 500 that have revenue surprises at whatever level they are. It could be a low level of expectation and they beat that, or it could be a high level that they exceeded. But in any case, here you've got in the black line, you've got, about 67% of the index constituents in the latest reading have revenue surprises. And then that's overlaid here with the manufacturing PMI, which we know has been consistently below 50. And so these numbers tend to pair up over time. They tend to overlay themselves. Say the correlation between these two is absolutely positive. It may not be, I'll call it, I'm eyeballing it here, maybe calling it about, 65, 70% correlated. But this is an anomaly right here to have these revenue surprises and then have manufacturing PMI be so low. And the thought is that those are going to meet somewhere in the middle here. We'll talk about construction spending, and we'll break that out between residential, non-residential. We've already alluded to this a little bit, but we have seen some positive trends in overall construction spending. And as we can see here on the right chart, that we've seen, really the bumper crop in residential. We know some of this to some extent has been single family, multifamily, but we know that a lot of it has been single family because we were underbuilding for, basically almost 10 years. And so, as of the pandemic, we were doing a lot of catch up. And so that continues. Non-residential spending has certainly gone up, but we see it beginning to flag a little bit. And we expect that that number is going to hold here. We've got, lower spending intentions. We've got, capital raising is expectations on the part of financial officers is kind of going down. People are not looking forward to spending as much or not doing as much capital spending as they have been. And so I think that number flattens out. This number at some point will begin to, you'll see less robust increases on a consistent basis and something that kind of flattens out over time. Here we have corporate profits. We've seen very strong corporate profits. I just showed you a chart about revenue surprises. This is the very interesting thing. I mentioned this maybe about a month ago. A very interesting dynamic. And you expect, okay, well, interest rates are moving higher. That's going to be a pinch on corporate America, just like it would be a pinch on, the individual having to pay more in mortgage interest, having to pay more on credit cards, so on and so forth. That is true. However, in corporate America, we went into the pandemic with such strong balance sheets that, and with profits moving higher, this directly led into this, which is the net interest expense has actually gone down because increased profits have led to increased savings, and the rate of gain on those investments is greater than what they're paying in interest because they have been largely delevered throughout this whole episode with the pandemic, et cetera. And so the net profit drag on interest expense is actually gone down. And so this is a self-feeding frenzy right here that, you continue to have high profits. It's going to drive more interest revenue, which will offset interest income. And then this will continue to feed that. So it is a self-serving loop of many respects. Mentioned this chart a couple of slides ago, and this just simply means that you've got fewer executives, fewer CEOs are looking for higher capital spending over the next 6 months. And that's just being conservative. You see the percent expecting higher capex has really dropped off here quite a bit. And then as a result, you would expect S&P 500 trailing capital spending growth is going to catch up with that. We have gold. Gold has been in a real upswing here as of late. You can see long time highs being achieved in gold right now. A lot of it has to do with the dollar. A lot of it probably more so has to do with interest rates. But we're seeing a lot of strength in the dollar right now. We have some charts on energy and crude and natural gas. These are all net benefits, especially during the winter months. So first of all, we'll take like Brent crude. Oil prices have gone down. We do know that OPEC Plus is trying to shore that up with some voluntary cuts, but I think the evidence will probably show at some point that there are a lot of people that will be cheating on those. They'll want to increase production or certainly not cut it like the cartel is asking people to. But prices are down, and that leads to lower gasoline prices, which are reflected here. Here's a year-over-year change, which has certainly been negative. And then over here, we've got natural gas prices. So if you think about winter heating, that's obviously very important. You can see levels. You've got to go way back on this chart, certainly before November of last year, to find levels that we are looking at right now. So gasoline, natural gas, all of the energy components are lower year over year. This chart is kind of goes hand in hand with the prior one. So as we look at OPEC showing some net production declines overall, and you can have production declines for a lot of different reasons, some of which can be intended, which is what OPEC Plus is trying to do right now. But you can have embargoes. You can have like Iran that where you have made very deliberate attempts to stall their energy production. You got other issues like Venezuela, that's kind of a third world country that doesn't have money for reinvestment into infrastructure, even though the U.S. reached out at a point where they needed more production on the market. So you got a lot of reasons why this number is lower, but it's being offset by increased production in the U.S., even as independent drillers have become much more fiscally astute with regard to drilling. Just because you see higher prices, you don't see a lot of caps coming off oil wells. People are using a lot more discretion. But even amidst that, we're seeing these net increases, which are increasing our leverage around the world, increasing the supply of product in the world, and helping to keep prices overall lower. That's all we have today. Hope you've enjoyed the chart pack. Have a great week, and we'll talk to you again soon. Bye-bye.